All right, welcome back. Another episode of Exploring the Process. You got Kristen here and I this week. It's actually holiday week for us, so it's Easter break for both of our families, and excited to kind of bring this to you. We are doing it a little bit ahead of time. So today is actually April 13th, although that's going to be released next week, right, man? But yeah, so hopefully we had a great second follow-up with Rivet, which we released last week, and hopefully you guys all enjoyed that. I know I certainly enjoyed sitting down, and if you couldn't tell, I was certainly glued to that screen. I loved what he was kind of showing me from the demand supply levels, all that kind of stuff. I really thought it was quite valuable. But this week, Chris has actually kind of got the subject, so I'm going to pass it off to him and let him kind of dive into it.
Okay, yeah. So I've been thinking about this over the last couple of weeks. There's obviously a lot going on with, not just with us, but with Hedge Nation as a whole, and lots of stuff coming out. Investing Summit, Keith joining in on the Twitter Spaces where he can, interact with, people that subscribe to Hedge in a different way than he does through, whether it's written in the early look or whether it's on the macro show. He can just interact in a different way. And so when I was younger, I used to, when I had the money and didn't have kids, I spent probably too much money on hi-fi. I loved music. I had, I'd vintage hi-fi. I would buy it secondhand. I would buy it from here, there, and everywhere. Then when I got a little bit more money, I would go and spend stupid amounts on speakers that probably I didn't really need, and amplifiers and CD players, and that was my thing, right? I'm not really a car guy. I love Formula One, I love racing, but for me, there's no point having a stupid crazy car on the road when you can't go more than the speed limits for me. So that was it. So I have a pretty crap car, so I spend all my money on hi-fi. But I know we've spoken before where I'd listen to quite I try and listen to different things. I'd follow not many, but diverse people, hopefully. And I do the same when I listen to some podcasts. And one of them, even though I'm not buying expensive hi-fi anymore, I still listen to a podcast by a guy that kind of, the way he thinks about hi-fi is the same way that I at least try and think about finance, in that if you're trying to extract some return from somewhere, you're going to be making a concession in another place to try and get that. So if it's like a back test or something, if you are developing a back test which works in a certain way, and you're like, oh, but you had a big drawdown, how can you take that drawdown out? Well, that's fine. I can take the drawdown out, but capturing all of the upside will probably be lost by trying to prevent that drawdown, if you're thinking it in like a trend following type terms, right? So by trying to eke something out extra over here, you're probably making a concession, or you're having to give up something on the other side of it. So here's the story, okay? Right, so Rob invites me around for dinner, okay? I go around to his house, nice meal, and he puts on some music, and we're listening to some music. It sounds great. Rob's got this nice hi-fi in his room. He has a nice room. Okay, let's just say it's a 5 by 5 meter square room. Nice soft carpets and picture frames everywhere, and the speakers are set out nicely, and we're sat in a chair that's nice and centered in between the speakers and a good distance away from there. Okay, so we have a few bottles of wine and whatever else, and we're talking, listening to some music. So I decide, right, I've just moved into my place. I don't have anything. It's like, right, I don't have time to try and research hi-fi. I just want to buy an exact copy of yours. Okay. And Rob, being the nice guy, says, well, we're going away on holiday this week, so why don't we package all of ours up, and you can take it home and you can use it at home for a week, and you can decide whether this is what you want to buy. Great. Rob, awesome guy, right? So I get it home, I set it all up exactly. These same speakers, the same amplifier, the same CD player, the same cables to connect it all up, the same power cables, because there's snake oil in hi-fi about whether certain power cables make hi-fi sound better, okay? Even you give me the 10 CDs that we listen to so I can listen to those exact same 10 CDs and say whether I like it or not when I use it at home. Okay. Rob comes home from his holiday. There's a package sat on his door, which is all of his hi-fi back with a note saying, this is shit. It sounds nothing like what you showed me when it was at your house. What a load of rubbish. I don't want it. Okay. Now, Rob, being a nice guy, tries to help and saying, how have you got it set up? How did you do this? How did you do that? Okay. That's, for me, that analogy is everything. It's like, it is Hedgeye. It's it's how people subscribe to Hedgeye. It's how people follow people on Twitter with trading levels. It's how we follow technical analysts and all these other things, or newsletters or whatever. You only ever see it how it's portrayed by the person that's using it. Okay. Now, the big difference about why it didn't work and why it was rubbish for me is Rob's never been to my house. He doesn't know what my house looks like. Okay. Now, he's picked his speakers, he's picked his amplifier, he's picked his CDs that he listens to based on his own choices and biases. And maybe he had some before in the past and he didn't like them and he chose to change them. Okay. To better suit your listening or whatever choices you made. Maybe it's your wife. Maybe you had a nice, big, huge set of speakers and your wife came in and said, now that I'm here, you're not having them in the front room. Right. Okay. That's a choice. That's a choice that's made. Right. It's a decision that you didn't make for you. It's a decision that was put on you, but you have to live by it now. Okay.
Yeah. If she watches this, it was a joint decision.
Okay. Right. Now, so Rob's never been to my place. Okay. So Rob, his listening room where he listens to his music is a 5 by 5 meter square. Mine is a 3 meter by 5 meter oblong, right? Okay. So it's a big, long room. It's a long, straight room. Okay. Now, Rob lives in, I don't know what you would call it, like a rustic house, which has, windows, but much smaller windows. And Rob's windows, because of the period of house it is, has nice thick curtains covering the windows. Now, my apartment is modern, and all down one side of the 5 meter long wall is all glass. And because it's modern, I have no curtains, I have no blinds, no nothing. It's just sheet glass going all the way down. Okay. Rob's got carpets, nice soft sofa for everyone to sit on that's right in the middle of the room. I've got a rock hard leather, very fancy, but very uncomfortable leather flat sofa. Okay. I have hard floors. I have bare walls that are all white. I have nothing. I have a minimalist house, right? The thing is, although I'm listening to exactly the same thing, I'm listening to the same speakers, CDs, everything is the same, okay? The way that sound is spread in your room with all these soft furnishings, soft carpet, soft sofa, you've got plants. Because you like hi-fi, you know that you have 4 big pot plants in the 4 corners because it's called a bass trap. So the corners of a room are a bass trap and they can spread sound and make it sound horrible. Okay. You know that. So you've got 4 pot plants. I'm a minimalist. I hate pot plants. So I have nothing. Right.
Yeah.
The point is that we're listening to exactly the same thing, using exactly the same equipment, but the place that it's put into completely changes the sound.
Mm-hmm. Mm-hmm.
Completely, like, sounds nothing like it. Okay.
Yep.
And this is like taking something like Hedgeye and just trying to completely parrot and just use it as exactly as it is. Like, you don't have the extra data that Keith has. So how can you possibly take RTAs? You can't copy it exactly as it is because you don't have the information that he has. But you can take the signal and try and put it into your own process. Take it into your own. Okay, if if it's a tiny single name stock, okay, I'm not going to buy it or sell it, but I know what I can try and figure out what is he trying to tell me? Like, why is he buying now a small cap industrial or something, whatever it is? Like, what can you get from it? It may not lead you to a trade, but you can take some information from it. Okay.
Completely.
So this is where, even though it's a product and there's a price attached to it, and there's always a kind of expectation based on price, of course there is, there always is. But you can't, at least for me, the way I view it, is it's a research service. Now, yes, there are trades and position size, like that's a part of the components that's shared through it. At the end of the day, it is a research process. It's a research product. You have to use it to augment your own process. You can't just copy it from scratch because you don't have all of the information. And even then, Keith, it goes back to kind of the macro show or the spaces that he has joined recently. That's kind of like different CDs, right? You can use now,
or even different venues, right? Like the different,
exactly that. So when I'm talking about the room, so when I'm talking about your room and my room, I talk about that as, that can be everything. Maybe that's the difference between having a $5,000 trading account that you're YOLOing around, or you've got a $5 million account that your main goal is just not to lose any.
Mm-hmm.
If you can make a little bit along the way, fine, but your goal is just not to lose any of that 5 million.
Yep.
As best, like you don't want any drawdowns.
Yep.
Okay. It's just different. It's just completely different. But the problem is that the people that are trying to help, and that's the thing, it's anytime that we've spoken about it recently, what we try and start off as is like quite a simple thing, just keeps going and going and going because it is complex. So there's no way that anybody can try and, in my analogy, you didn't know what my house was like.
Mm-hmm.
So if you try to help, you can only go by what you know, and you only know what I tell you.
Right.
And and I'm not saying and this might be contentious, but if I'm portraying that I'm something that I'm not in terms of the account or anything else, you might be making assumptions in trying to help that aren't true because you don't have all the information.
Yeah, like
because at the end of the day, this is all trying to happen across the internet, right? None of us really know each other, especially random people on Twitter that ask for help.
Completely. Yeah, I mean, to your example, right? Like the night that we were having wine and listening to music, you may have just, again, not really specifically or perhaps inadvertently kind of come across as, also knowing some hi-fi components, right? So when you're setting up your, when I was, quote unquote, kind enough to let you trial it out, I didn't give you any additional instructions because, it was my understanding or kind of my thought that you sort of would know how to set it up inside your own house, right? Or kind of how to adjust, the positioning of XYZ, the speakers and all that kind of thing. So yeah, it's a really good analogy, Chris. And one that, is one of the reasons why I don't want to say hesitant, but I don't really think it's my place, right? To like on Twitter, for instance, right? There's many folks that give out like what they're doing position wise, right? Like what they're trading, all that kind of stuff. And for those that do it, I mean, I'm certainly not poo-pooing it or anything like that. I'm just saying, I'm just conscientious that everybody has a different scenario and different situation that they're in. And so my goal as a 37-year-old, right, who's trying to grow and compound wealth is different to your example of somebody who's either retired or has, or might be 47 or 57, right, and not quite retired yet, but they've built that nest egg. And to your analogy, the biggest thing is they just want to, maintain it and not kind of have the big drawdown. So the approach that we will take will be very different, right? So we may have the core concepts and the core philosophies and even the core components inside of there, or the longer term kind of outlook will be the same, but the way of getting from A to B could be completely different, right? So like I might leverage, inverse ETFs, or and not just do 1x and go 3x, right? Because I'm like, okay, if I'm going to be right, I want to be really right. But then conversely, I also, for instance, yeah, like next week, kids are on holiday, you too, right? So I might just kind of peel down the portfolio a little bit, right? And kind of keep it to some core stuff. So I'm not having to, again, not that I stress over it anyway. I really don't stress over it any day, to be perfectly frank with you. But but I know I might not touch it as frequently, right? Like my sister's coming for a visit for the first time with her daughter. So it's, so my niece and sister will be here. So I just know it's going to be a little bit, it's going to be a different week next week, right? Than a traditional week. So all those components, right? They all factor in. And then the flip side of that too is also, it's also not, it's not necessarily knowledge to me. It's more about the, like, kind of like the absorption, right? Or like, it's like building the puzzle. Because Chris, you make a great point about Hedgeye. It's like, it's a research tool, and it gives you lots of pieces of a puzzle, right? And lots of pieces and different aspects of data that you can put together and form your own thoughts. And I think the biggest thing, and something that we've certainly talked about over the last 3.5 months, is that you have to build your own concepts, your own process. You have to, again, follow your own kind of path, right? And it may mesh with Keith, and what he's saying and doing, and it might not, you might, and it might work and it might not, right? Like, like with our, you and I talked about, Japanese yen is a good example, right? So we I put that on 2 weeks ago, right? And I thought it was oversold and was going to get a bounce, and Keith's been absolutely dead right? And like, I played it. I still have some on, to be honest, because I still think it's going to bounce, but like, I'm down like 3%. So again, it's like not the end of the world, but it's like, it's at the same time, like that's a decision I made. Right. And I was wrong. And I, probably, definitely looking back at the tapes, could have played it differently, could have had a closer stop loss or any of that kind of thing, right? So I could have, there's definitely times I could have, anyway, point is that I made a decision. Keith didn't say anything. I'm using his risk ranges, right? It was at the top end of his risk range. It had been, and kept probing that top end for like weeks at a time. It just keeps doing it, right? And sometimes you just get into that situation, kind of like, yeah. So again, just as an example, right? That's just one recent example in my life that, or my portfolio, that I, use tools and overall outlook from Hedgeye, but made a decision that was not something that Keith would have really approved of, and it didn't play out right.
I quite like when you said, so talking about next week, okay, when you use that as an example, okay, you're going to have to make not necessarily a lot of changes, but you're just going to have to think ahead, because you are going to be away from the desk, right? So this is kind of the this is a bit, of course, that goes with both, whether it's like trading products and hi-fi, right?
Yeah.
A big part of it, and so big part for both, okay? I can change my room, okay? So now that it's all stark and white and no soft furnishings, I can go to IKEA and buy a big, massive rug. It won't make it perfect, but it will make a big difference. It will stop the sound reflecting off of the floor, and it will make the sound a little bit better. It won't be perfect, but it will be better. Okay. I can go and buy some plants. I can
I can
buy your grandmother's artwork and hang it up, different sizes. The different sizes of artwork will reflect the sound differently and diffuse the sound a bit better than having stark reflections off of flat walls. Okay.
Mm-hmm. Mm-hmm.
This is all important. I can change my sofa. Instead of being this flat Italian leather square sofa, I can change that. It will make the sound better. It won't make it perfect, but I have control of it. Ultimately, I could move to a house with a square room that's just a dedicated listening room of nothing else, just hi-fi. That would make it great. And then I could change, right? But that's the same for this analogy in my head. It's the same for finance. I can change my rules for me based on sizing. I can change my rules based on stop losses or targets or whatever? Or do I split? Okay, I have a 6% position size in an equity ETF. Okay, so do I treat like 2% as like trend following? So when it goes bullish, I buy it no matter what. And that's my minimum. And I don't sell it until the trend breaks. Then I play with 4%. What do I do with that 4%? Well, I use 2%, but they're my rules. I can change them. They're mine. They're my house. In this analogy, they're my room. That's my room. I can change. I have a decision. I can either have crap hi-fi, I can have crap sound, but keep my minimalist room, or I can have better sound and change my room to try and make my hi-fi sound better. Okay.
Yeah.
Now, the difference is with products that are trying to constantly sell you new things, and it goes with both, okay? Someone trying to sell me a new $5,000 amplifier, they know nothing about my room, right? But they're going to try and sell you it because they sold you the $2,000 one 5 years ago, and now they want you to upgrade, okay? It doesn't mean it's going to make the sound any better in your room if the room's not prepared for it.
Yep.
Okay. Yep. It doesn't mean that that new amplifier is going to talk to my speakers very well. Okay.
Yep.
So just because you have a system that's in place doesn't mean you can just start layering an options. Let's say, like, you can't just start layering in an options strategy because your room, your boundaries, your set rules might not accommodate it. Going from just buying underlying ETFs to trade in futures because of the inherent leverage that there are in futures, it doesn't mean that your rules as they are now will automatically be able to, it won't just be a one-for-one swap. Like, I can't just take this set of speakers and swap them for this set of speakers that are bigger, because the room might not be able to take it. You might have these big, huge set of speakers, let's say options, right, in a teeny tiny room, right? It might not work, or you have to change your rules to suit the new strategy or the new bit of equipment, right?
Yeah.
And just to finish off the analogy, okay? If you have a good set of rules in place that you follow, okay, just like if your room is prepared for music with all these things, soft furnishings, plants in specific places, or you can buy specific stuff to try and suck some of the sound and reflections out of the room. That will have a positive impact on no matter what equipment you put in.
Right.
So it will make a $500 like Bose Bluetooth speaker, it will make it sound better because it doesn't have all the negative impact of the room. Conversely, if you put a $5,000 separate hi-fi that you've picked out, it will also make that sound better. You could buy a $50,000 hi-fi. If your room has these things that you're in control of, you can make that hi-fi sound better than if the room had nothing done to it whatsoever. Yep. The reason why I like this analogy is you're in control of the rules that you use, just like you're in control of the room that you listen to music in, okay? And actually, you might get more benefit out of taking the time to understand your room than it will be to go and spend $5,000 on a new set of speakers that you may not need if you just do the things that you need to do in your room.
Yeah.
You may not need some fancy new data source or new product or new whatever, and it might not suit you. That's the other thing. But you may not need it if you get the things that you have direct control of: position sizing, stop losses, your research process, or whatever it is. You have direct control of that.
Yeah.
And you need to get your house in order, to kind of twist the analogy around, but you need to get your house in order.
Yeah.
And the thing is, if you get that done and you have all those basics done, and it's hard to try and share it because it's different for everyone, your set of rules are going to be right for you, and they may change over time. But then it's more likely, if you get another research product, or if you only trade underlying, but you want to layer on an options process or an options strategy or something like that, it's more likely to work if you have the underlying basics, wrapped
No,
up.
it's just to kind of keep going to this analogy. It's like that conversation with Mike Taylor on Monday, right? So Keith had him on Investing Summit. He was kind enough to join, Spaces that evening, and he's such a wealth of knowledge, right? But he also has, to use this analogy, he's basically the equivalent of Dr. Dre, right? He is an absolute music producer with a room, right, that is built for sound and built for producing music and listening to music and, tweaking it constantly, right? So like he is on a Dr. Dre, producing level, creating, Beats by Dre, aka, being a manager of the Pink ETF, right? And that kind of thing. So like he, again, so like sometimes I do struggle a little bit with like having some of these very accomplished folks come on because it's an open platform Spaces, right? So you've got folks that could be 14 years old or 18 years old that are listening. Again, it doesn't matter how old they are, but you could have absolute like newbies, and just because newbies can be 18, they can be 78, it doesn't really matter. But like, you can have newbies, you can have, kind of guys that have been doing it for a little bit of time. And Buddy Carter actually talked about this too yesterday, in terms of just because you've been doing something for a while doesn't mean that you are either good at it or can handle a more like complex system, right? So, when Mike was talking about, he basically being like net short 108%, I think was the number. That's even Keith was like, whoa, right? Like, when you got like a pro like Keith being like, that's shooting your shot, like, right? Like that is a directional bet. You, again, if you're not hearing that from Keith, from another pro, then if that goes over your head, or if you just didn't catch it, then it's a really important, like I sure shit didn't go out and like basically put my account at net short over 100%, right? Because it's just not, that's just, it doesn't fit into my room, into my box, into my hi-fi zone. And it's wonderful to hear that. There are definitely snippets out of that conversation that you can apply. Like one of them I mentioned on Twitter yesterday was about, if you're looking at like the, either putting options on an underlying ETF, go and look, one of the things Mike Taylor was like, basically every hedge fund uses the core ETF to hedge their position. And so oftentimes those contracts are quite expensive. So, go look at, the top, go look at the ETF and look at the top 3 holdings, whatever. And you can basically take a similar directional bet on that same like consumer discretionary, whatever it is, tech, and by using options on the underlying individual equity, right? So it's just like a different thought process and something that you see visually, right? And you notice that like QQQ, put options are more expensive than, putting it on Microsoft or Apple or what have you, right? So like you can see that visually, but having it a pro really, again, and like you kind of are like, I already kind of knew that, but like having a pro reiterate it and be like, yeah, no, I don't have QQQ put options. I have Apple and Microsoft and Amazon put options, right? And that kind of thing. It's just, those are snippets that I think are really important. And even options, like I don't really play in the option space that frequently, to be perfectly honest, because it's just not something that I've given, just haven't something that I've given. This is not something that I've given it enough like energy and effort and time to sort of like fully understand. And I think it's a totally different way. It's a totally different way of, it's a totally different way of trading.
Exactly. The rules that you have in place for trading the underlying they may, but they may not just be able to swap straight over to trading options. It's different. It's different. It's
different. Yeah. And I think
you can't always expect you can't always expect it to just, I'll just start adding options. I'll just start trading options now. And
right.
you can't.
Because like, even if you have the position sizing, it's then, okay, fine. Like I'll cap myself at, say, 50 bips, right? I'm just using that as a round number. But so if I say, okay, my max options position is going to be 50 basis points in my portfolio, the way to trade those, though, and something that I've learned over a lot, basically since kind of dabbling my toe into it last June, is that the moves are just so much, obviously there's just volatility is there. So the moves are so much more exacerbated both on the upside and downside. And then you've got to, like, again, like, we don't need to get into like all the Greeks, but then you've got the theta decay, right? So like the closer you get to the option expiring, you might be, again, I'll just use an example. Let's just say it's 50 bips, right? But you're down 20%, and all of a sudden that drops to like 50% because you're just that much, you've gone from 2 weeks away from the option expiry to one. And so there's just not as much, like, basically their state of decay, and then the delta shifts. And so, even the move in the underlying doesn't reflect as much as you would have thought it would have when you put the options on. And all of a sudden you're like, okay, well, what do I do with the 50, down 50 basis points, or sorry, 50%. So now I'm at like 25 bips, right? So, okay, do I average in because I can get my max back up to 50 bips and sort of, basically take my cost down and try to trade around it that way. And again, I think it just becomes much different because, buying and holding it doesn't necessarily work, and taking a loss sooner, basically what I've found, taking a loss sooner is a much better strategy, where you can, come back into it either at a lower price, or just let kind of some time and space play out so that you can see, okay, was that even right? Do I need to go from the April 17th, whatever, I think it's the 14th, I guess, this year or month. So do I need to go from the April 14th to May instead, right? Like, do I need to give myself some more time and space, blah, 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 right? Or do I go out to June? Anyway, all sorts of different components come into different.
So that's a perfect example of why the rules that you have just for trading SPY don't match trading options on the SPY.
No, completely.
So because, and that's, it could be anything. It could be changing the asset that you're trading. Like, just because you've traded equities for the last 5 years doesn't mean you can trade commodities exactly the same.
Or even crypto.
Or whatever, or bonds, or you can't just automatically jump from the underlying to futures, or jump into options.
That's exactly what. So you and I talk a lot, obviously, right? And like, you primarily trade futures, and like, I've never in my life traded a futures contract, and obviously it's something like that's interesting to me. But for me to even dabble into that arena, I would start now paper trading it basically till the end of the year, and then have it be a goal for like 2023 to transition to like futures. Like, if I was really serious about it, I'm not currently at that level, but that's basically, that's what I did with like FX. I opened up like a paper account on IG in June of 2021, and I basically traded it paper all the way until March of this year, when I finally got comfortable and was like, okay, like, let's put some real money to work. Like, that was 9 months, right, of basically dabbling into a new market. And again, for whatever reason, FX, I don't know what it is, but like, my brain kind of like thinks in I don't know what it is, but like, FX like makes sense to me. So it's like it's fun, and it's obviously fun when you win. It's like, obviously it makes life more fun too, right? So we
wait until the Swiss National Bank devalues the currency on you. That'll be
exactly.
Yeah.
So anyway, but
but that's it. I just like the analogy, because, like I said, this podcast, this guy that I listen to kind of talks about it in the way that I talks about music and hi-fi, in much the same way as I try and talk here. It's like there's always something to be gained, but often in trying to gain something, you have to make, you might make a loss somewhere else. Like I said, in order to try and stop you taking a drawdown, it might stop you from capturing as much of the upside. So there's always a balance, and that balance changes over time, right? Let's just take the quads, right? In quad 2, have at it, everything. You know, that's what I did that last year. Quad 2, I'm like, right, I'm not playing around. I'm going where you're going to get the biggest. So that was crypto. Now, but since then, now that we've transitioned into Quad 4, my account is like super boring. Like even shorts, I had very little shorts on until like maybe 2 or 3 weeks ago when I first started my NASDAQ short, and it was tiny compared to all the boring stuff like gold and the dollar, you know. So my balance swings quite a lot. So, you know, when we go back to Quad 2, whenever that is, whether it's in a month or a year, you know, without being like, I won't be fucking around with US equities. I'll be going back to crypto and just swinging for the fences. I'll have position sizes to accommodate that risk. But in order to give me enough space in my account, I won't be messing around with some like equity ETFs and stuff, because they'll just be taking up space.
So did you have to shift much other than position sizing when you did that, when you transitioned to more of the crypto and Quad 2? Because I think from your momentum, so if I may, from an outside perspective, because of your momentum trading and like background and the kind of like how, like, to me, that suits the crypto space, even futures, like it even options too. Like it suits that world where you're kind of, your mentality is sort of like not necessarily in and out completely, but because I know you'll keep some things on longer term, obviously, like for more full cycle. But again, I don't want people to think that you just are constantly trading, because you're not, but you'll take the profit, right? And I think that's a huge thing with certainly in options world. I don't necessarily always take the profit, and I'm getting better at it. And it's not just options; it's in the underlying too, right? I don't necessarily always take the profit and pay myself, and that's something that I did very poorly the first like 18 months of being a hedge sub, is that I would be right, but then I wouldn't. I just kind of keep leaving it on, and certainly in crypto land.
But that leads into the thing that we've talked about almost every episode, which is like the dominoes, right?
Yeah.
If you get the first domino of building your position when nothing's happening, you then afford yourself the ability to try it, because you're not chasing. If it moves on you and you didn't have, and you're not big enough, you're not chasing it. You're not like, oh, well, I'm taking profits on a position size that was only 2%. Mm-hmm. I'm not even at my max, you know? So the example over the last couple of weeks, the last couple of videos has been gold, right? So almost as soon as gold moved, I already had to take some down because I was already at my max. So it didn't need to move much for me to be at 12.1%. So I automatically had to take 10 basis points off, because I was breaking my own rule. So in terms of crypto, I was looking at a lot of different stuff at the time, because you never know, like just some random bit of news could pump one or whatever. But you would start to see repeating, I guess it goes back to the fractal thing, you would start to see repeating patterns. And although my position size was much smaller, like 50 basis points was a max for some of them. Right.
Sure.
It was basically like an option.
Right.
So, but you could start to see some of these patterns, and sometimes they didn't play out, and then others they did, and it would go up like 20% in a day. And and it's different, right?
Yeah.
So
that you took more of like a basket approach, I'm assuming, right? Kind of like shotgun sort of, you know, stuff that had momentum or the setup, what have you.
Yeah. But then it's kind of the same as so the scenario that I'm saying now of like when Quad 2 comes back, I'm going to go to where the crypto even exists when Quad 2 comes back, right? But what I mean is, like, you effectively used Bitcoin as the VIX for all the other pieces of crap, right?
Yeah.
And I have no idea what any of these did. I have no idea. But you were using one as basically as kind of like the VIX for the rest of the basket.
It's basically a
size the basket based on.
Yeah, that makes sense. Interesting. No, it's it's a good analogy, Chris, because, and again, it's really important, and in terms of, I had a conversation yesterday with a gentleman, and he's an investment advisor here. Like they kind of opened up their own independent shop about 6 or 7 months ago, and they're deploying the hedge eye process. And he kind of had a couple questions, that kind of stuff. And I prefaced it being like, listen, I don't know how, when you're doing it, when I execute hedge eye for myself, it's completely different than if I was going to be, not completely different, but it's definitely different than like if you're doing it professionally, doing it for other people's money or inside of other accounts, because they have their own risk parameters and, restrictions and stuff like that that's on there, versus like what I can do or you can do, or Leslie who's running her own money, stuff like that, right? Like it's just different. And so, some of the rules and parameters and the way that I can either, that we can either trade or not, is just it's just a different philosophy. So you have to kind of take different pieces and be like, okay, how do I want to apply the general themes or the general directions? And again, if I was in that seat, I'd be kind of doing a bit more of what like Gavin does, which is like try to capture the full investing cycle. So that I'm, again, not that this firm was churning their client portfolios, because they're not, but like, it's just, I think to me, it's easier conversations with clients if, again, like there's a portion that's more trading and more active, but then there's another portion that's basically, okay, we're going to ride out this bond exposure, right? We might have been early or what have you, but by the end of the year, I think, I'm pretty confident we're going to be very right. or, commodity, whatever the commodities is, or gold, right? It's like, okay, we just took it up, gold up right to the max here again. We did it at the beginning of the year. We did it again here in, late March. And boy, is that, proven right. Right. So again, just like capturing those full investing cycles, but, it's all different, right? Like you can also, to the flip side of that, like if you're wanting to try to, it's not even chasing your own tail, but if you want to be more active with it, you can try to play the chop bucket, right? And the volatility is at the top end of the risk range, you can go long. And then when it goes to the bottom of the risk range, you can sell that and go short, right? Like that's, it just depends on what you want to do, right? If you want to be super active about it, or if you wanted to be more passive, more aggressive, less aggressive, if you want to, again, I think it just all really depends on your mentality, the time of the day you have, all sorts of other things. And something, I think most folks know, but like I have a full-time job, right? Like it's, and a family. And so, when I'm consuming hedge eye stuff and then deploying it in the portfolio, I mean, that's a side project, right? I mean, that's a side activity. And so even then, I try to tell folks again, like, I'm not a guru. I'm not a like Sherpa, whatever, that's going to get everybody up the mountain, right? It's just like I can, every day I try to, I've talked about this before. Every day I try to do at least 3 things, right? So like read the early look, write down the risk ranges, and watch the macro show. Now, I don't always catch the macro show live. I also don't always catch the risk ranges depending on when they come out, like right before they open, right? Sometimes I'm doing it like literally at like 9:15 or 9:45. Like it just really depends on my day. Like sometimes I'll have a morning meeting, sometimes I don't. Like it just really depends. but I'm still, that's part of my process and part of my hi-fi setup is like those are the three of my key pillars, right? And then I factor in other aspects like the call and stuff like that too, right? But these are all things that I don't always catch live, and I think it's okay for folks, like if you can't catch it live,
if you miss bits, it's okay.
It's not correct.
We've talked about something just like between, like, I mean, the difference between you and me is I have the chance in the morning before the US is up to, if I missed a trade at the US close, let's say, if it's in futures, I can put it on in the morning before you guys are even up, right?
Yeah.
But there's certain times where I think, I missed that, and I put it on, and it was the wrong thing to do. And sometimes it's the right thing to do. That's like everything.
Yeah.
Someday you'll miss the risk ranges and it'll be the most important day.
Yeah.
Other times you could spend 6 weeks every day religiously watching the macro show, and it's all kind of the same thing.
Mm-hmm.
And then when you go on holiday, it's like, right, this is the week when everything is kicking off, and it's the week where you had to watch.
Exactly.
Right.
Which is basically next week, because it's like earning central next week. Yeah. Basically.
yeah. Exactly.
Yeah. No, completely. No, it's anyway, but
It's
yeah,
like,
I mean,
that's why I like that analogy, because there are certain things that you're in control of, and it's hard to do it. It's like I've said, like with the notebook, like just start it, it'll be crap, but you'll know what's rubbish and you'll work to making it better. Setting these rules is something you're in control of, and they won't be right from the start. Maybe you copy someone else's and try and jumble them up to more suit you, but that's the point, is you're in control of that.
Yeah.
But if you just subscribe to some random other product or another hedge product, even sometimes doesn't mean that that's going to work for you, because in the whole hi-fi analogy, your room might not be able to accept it.
Well,
and it's just not suitable. Maybe it's a wrong type of music for you. Or
when I think we've kind of gotten this point across already, but maybe we'll just end on this, is that it's kind of three things. One is assess what's right for you, right? Assess what's right for you. Assess what's right for your room, aka your portfolio, your family, your situation, and then, you know, I think to follow to that, and one big thing is like, it's okay not to trade every day, right? Like it's okay. Like if that's not one, sometimes that can be more helpful because you kind of let your positions breathe a little bit, right? And so, you know, I know Keith touches the button a lot, and but like that might not be for everybody, and it's okay if it's not for you, right? It's okay. And if the macro show is a great tool that you can leverage, and then, but like realistically from an execution standpoint, it's just sort of following the ETF Pro models, or maybe having the investing ideas on as well, right? Like, you know, again, just assess what's right for you. Like there's also nothing wrong with just having like ETF Pros. When he adds it, you hit the button, right? And then you go and forget about it, right? Or not forget about it, but you follow along in other ways, and you get updated in other scenarios. Like it just, you know, there's the saying, different strokes for different folks, right? And it's just like, it's very true. And, you know, the way that Keith has built his system for himself, again, like I don't know if you can ever be an ex-hedge fund manager, but I mean, he's an ex-hedge fund manager. I mean, he was executing at the highest level, right? I mean, he was running, I think, like $500 million or whatever, right? In his own book. Like it's a lot of responsibility. It's a lot of reps. He has a lot of reps under his belt. You know, I don't have that many reps. You don't have that many reps. You don't have that many reps, right? Like we don't run that kind of money either. And it's just like, you know, and again, it's just, sometimes you just, obviously the whole point of this conversation is just trying to understand what's right for you, and then just be comfortable with that, right? And you can observe, right? Like there are times I'm observing folks doing options trades, and it's like, that sounds like a really good strategy. I am not going to put that on. I'm not going to go buy TLT call options, because even for the end of the year, even if it, you know, means I don't have to deal with like the volatility underlying security right now, the price, I just would rather own the underlying thing and deal with kind of trading around that, right? And having my stop losses on, or my profits, because I just don't I just don't have experience with longer dated call options. And it's just not something, same thing with like some of these like shorts, right? It's like these puts, I don't really have any puts on. So it's like, because it's just not something that I'm comfortable with. I'm not comfortable with, and I could see myself blowing up my account by doing it. So, and I don't want to do that. Yeah. So anyway, I mean, again, I feel like this was a bit more of like me on the couch session versus, you know, it's like getting stuff off my chest, but it's just true. I mean, again, like I don't want to portray myself as doing anything that I'm not. Like, you know, I do trade some options, but it's very infrequent. I primarily, you know, focus on underlying security, like ETF, US listed ETFs, and some individual securities themselves, right? Some equities, but that's kind of how I approach things. But it doesn't mean that that's right for you. It's not right. There's hedge guys in Australia, in Singapore, like, I mean, they're all over the bloody world, right? So like, if it's not right for you, like, play the FX market, right? Play crypto, like whatever it is that you want to do, like just take the pieces of the puzzle that make sense for your house.
Mm-hmm. Yeah, it's perfect. Yeah.
Awesome, man. Well, good stuff. Well, thanks for a great session. And for those watching, we'll obviously see you guys next week. And I think we're going to have a guest. It'll likely either be, the Air Force pilot we keep mentioning, or this other woman, Lisa, who listened in on the call with Mike Taylor, and she had some great, tweets about it. So I'm really excited to bring her on as well. So we'll have a special guest here again soon, and I hope you guys enjoyed the session. And obviously, comment, like, whatever. Always open to new ideas, new concepts. If you want us to tackle a certain subject matter, that's it's kind of why we're here, right, Chris?
And if you don't like it, press the like button twice.
Exactly. Hit it twice. Awesome. See y'all later.